Good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a strategy that's slightly more advanced, but really provides investors with the flexibility of truly utilizing options for very customized payoffs. And both strategies are limited risk strategies. It allows you to take a directional view, either mild or neutral directional view, and be able to utilize the benefits of both buying and selling options. So it's really important for investors on this particular webinar to have a basic understanding of buying versus selling calls and puts. This is something that we actually have a course on if you want to learn more about, but you'll be able to apply the fundamental building blocks of options to construct these what we call time spreads, calendar and diagonal spreads, where we're buying and selling options on different expiration dates. And we're going to talk through when you can utilize them, how these strategies are constructed, and the best practices for trading these types of strategies. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So this is the second part of our options education calendar here for the first 4 sessions. 2 weeks ago, we launched again 2021 education sessions where we went through a Nordic market update. We looked at where the current markets are trading, what sectors are strong, what sectors are weak, and showed you some of the ideas and how we would utilize options to leverage those ideas with limited risk. Today, we're here to talk about a strategy, trading calendar and diagonal spreads, time spreads, understanding time spreads, having a better understanding as to how they work. Next, 2 weeks from today, we're going to come back and do the market outlook again. So every single month, we're going to come back and we're going to update you on the broader markets, different, giving you a better sense for what has changed in the markets and what our outlook is as strategists. And then coming back again 2 weeks after that to talk about another option strategy. We're going to talk about longer term investing using options. So buying longer dated options to finance the purchase of a stock position or stock that you perhaps might want to hold. Now, everyone here on this webinar is already registered, but if you're watching a recording, or if you're watching this somewhere else, you can sign up for this whole series of webinars by going to trade.optionsplay.com/OMX. So if you're not signed up for this, just go to that link and you'll be able to register for all of these events from that link. So today we're here to talk about is, like I said, time spreads. So in order to understand time spreads, we have to first take a look at the difference between trading stocks versus options. And then we're going to look at buying call options, because at the fundamental core of these time spreads is buying calls and buying puts. Now, we're not going to cover both calls and puts because they're effectively mirror images of each other. If you can understand call time spreads, you'll be able to easily understand put time spreads. I think it's better for us to dive a little deeper onto one side and truly understand it, because if you do understand it, you can easily apply it to the bearer side with the put side. So then once we understand the basic fundamental building block of a long call, then we're going to take a look at buying calendar spreads, and we're going to take a look at buying diagonal spreads, which are 2 different variations of time spreads. Then we'll talk a little bit about what are kind of the optimal spreads with both of these, and then open this up for Q&A with some real examples here at the end. Because I think the best way to learn always is to apply what you've learned to the real markets. So the primary thing I want to help investors walk away from today's session is an understanding as to how you can use options fairly creatively to reduce the risk and reduce the time decay of a long call or a long put, because that's really how you can think about a calendar and diagonal spread. Even though there is one other strategy that's really more neutral, it's not really comparable to buying a long call or a put, but it's something that we'll talk about here today. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you, the strategies that you can use, or how creatively you can utilize options to really provide fairly customized payoffs for the outlooks that you have in the broader markets, and more importantly, how to do that with limited risk. So we'll start off by talking about stock versus options trading. And I think everyone here is fairly familiar with trading stocks. So if everyone can please bring up your chat window, which is at the bottom of your screen, and please type in one if you currently trade stocks, if you buy or sell stocks in your portfolio. One, if you currently trade stocks, buy or sell stocks in your portfolio. Okay, so I see a lot of ones. And how many of you trade options? Please type two if you currently trade options in your portfolio. Okay, so I see a lot of ones. I see quite a few twos, but not as many options traders here as stock traders. Okay, so great. So we're going to introduce these basic option strategies and show you how you can enhance them a little bit by trading these time spreads. So most of you are familiar with long stock or short stock as a pure bullish or bearish exposure. Today, we're going to talk about our calendar and diagonal spreads that can be used for either a bullish or bearish view here in the broader markets. And more so diagonals for bullish and bearish. We're going to talk about calendar spreads actually as a more neutral strategy. But the reason that we look at time spreads, the reason that we trade time spreads really comes down to the fact that when you look at the theta or the time decay of an option, it's not static. Meaning, depending on where you are in terms of how much time there's left between now and the expiration of an option, the theta decays at a different pace. If you buy a long dated option, the theta decays at a much lower pace. If you buy a short dated option, the theta or time decay decays at a much faster pace. So when you buy a shorter dated option, the value of that option will decay faster than if you buy an option that is later, that expires at a later date. So this is what we want to try to use to our advantage when we're trading a time spread. Effectively, what we want to do is we want to buy options out here because they have lower time decay, because when you're buying something, you don't want the value of that thing falling very fast. And when you're selling something, you want the exact opposite. You do want the value of that option to sell very fast. So what you're doing here when we're trading time spreads is we're trying to take advantage of this theta decay curve, and we're buying options that are longer dated, and we're selling options that are shorter dated, and taking advantage of theta decay that we're selling, and then buying something that has relatively low theta decay. That's the primary premise of trading time spreads. So in order to understand this, let's take a look at some examples here. Now, I apologize. This should say, here we go. So I apologize. This should say SEC. This needs to be updated with the other slides. I apologize for this, but what we're going to start with is a understanding of a call option, because a call option is something that most of us have a basic understanding of. Now, there are some challenges with call options. So let's just go through an example here. Let's say you have a stock that's currently trading at 130 crowns. And what we're doing is we're buying an option, a 6-month option for a certain amount of price. And the benefit of a call option is the fact that you have unlimited potential gains. So if the stock keeps going higher and higher, you'll make more and more profits. But the benefit of an option is that you have limited losses, so that no matter what happens, even if the stock that you bought a call option on goes down to zero, you cannot lose more than what you pay for that call option. So that's the main benefit of trading a call option. But there are some major challenges when it comes to buying a call option. And that's the fact that you have to overcome the cost of the call option in order for the strategy to break even. So if you have a stock that's trading at 130 and you buy and you pay 13 crowns for that call option, and the break even price of that option is 143, which is the strike price plus the premium that you pay, $130 plus 13 crowns is 143 crowns. You have to expect the stock to move above 143 crowns at expiration just to be profitable. Meaning even if you are correct on your directional view, and let's say this stock only goes from 130 to 140 crowns, so it moves only 10 crowns higher, even if you're right on the direction, you'll still lose money on the trade because you did not overcome your break-even cost. And this is the biggest challenge that you have when you're trading a call or a put, because you have to overcome the premium that you're paying. And largely, the premium that you pay is based on the market's expected move. So when we say that a call option costs 13 crowns or 15 crowns, that price is effectively the market's expectation as to how much that stock can move. So saying on average, based on historical volatility over a 6-month period, this stock is likely going to move roughly either 13 crowns higher or 13 crowns lower. So even if the stock makes the expected move, you're just going to break even. You're not going to be profitable on that trade. You have to have a bigger move than expected in order to be profitable. And that's hard to do. You're basically, when you're buying a call option, it's almost like saying, I think the market is wrong. I think the market's expected move is wrong. I think the stock can move more than what the market expects. That's what you're truly expressing when you're buying a call option. And that's not easy to do. So what we're going to do is we're going to show you 2 time spreads or 2 modifications that you can make to that time spread so that you can potentially trade a different strategy. We're going to talk about a calendar spread and a diagonal spread. Now, a calendar spread is really I would say, an alternative to another strategy that we generally don't talk about very much, and that's a short straddle. How many of you are familiar with a short straddle? Please type 3 into the chat window if you're familiar with a short straddle, or maybe have heard of that strategy. Please type 3 into the chat window if you've heard of a short straddle or maybe have traded it. So Corinne, all of our events are recorded. So yes, these are recorded. So with a short straddle, it's one of the most efficient strategies to trade because you are a short volatility and you have very little delta exposure when you're short a straddle. But there's 2 main problems with shorting a straddle. One, you have truly unlimited risk when you short a straddle, meaning if you short a straddle and the stock rockets higher, right? You have unlimited losses here to the downside. You can lose more and more money if the stock keeps going higher and higher and higher. And vice versa, on the short side, if the stock declines to the downside, you have substantial losses, but the stock obviously can't go below 0, but you still have substantial losses to the downside when we look at shorting a straddle. So when we talk about trading a calendar spread, the benefit of trading a calendar spread, as you can see from the risk profile, is that you have a risk profile very similar to short a straddle, but you have 2 key things. Number 1, you have limited risk with the strategy, so you're not exposing yourself to unlimited risk. And number 2, the amount of capital that you need to get into the trade is only the debit that you need to pay to get into the trade. Unlike a short straddle, you have to post margin in order to hold on to that short straddle. When you trade a calendar spread, you just have to pay the debit to get into the trade. That's the most you can lose, and you have max loss of what you pay. The similar to buying a call option, where the most you can lose is the price that you pay for that call option. When you trade a calendar, the most you can lose is the premium that you pay for the calendar. So I have an example here for SECU. The stock is currently trading at about 150 crowns. What we do here is we do the same thing. We buy a 150 crown option, the at the money call option. Let's say that call option costs 10 crowns. And what we do is we sell a short dated option, in this particular case, a 1-month option at the same strike price. So you buy an at the money strike price and you sell a 1 month at the same strike price. So let's say you pay 10 crowns for the 6-month call, and then you collect 4 crowns for the 1-month call. Your net debit on this particular trade is just 6 crowns. So on a 150 crown stock, your net debit is only 6 crowns, and that's the most you can lose. So it's a really interesting way to replicate a short straddle, but do so in a way with limited risk. In this particular case, 6 crowns. And you do not have to post any margin in order to trade that. You only need the 6 crowns per share in order to enter this trade. Now, this is a little different from a straddle from the perspective of this P&L graph is only true up until the expiration of the first option. Once the first option expires, you're back to owning just the long call. So you're basically back to this particular view. But remember, if you just bought a 6-month call option, you would have had to pay 10 crowns for it, meaning your break-even price here would have been 160 crowns. So if you just bought a call option, long-term you're bullish on the stock, your break-even price is 160. But if you trade the calendar spread and the stock stays below 150 crowns, you've now effectively reduced the cost of your 6-month call option from 10 crowns down to 6 crowns, which means that your new break-even price is now 156 crowns. And you can continuously do this. You can continue to sell short-dated calls against your long call to reduce the cost basis of that long call, but you do have some risk with doing so. And when you sell a calendar spread, you have two possible outcomes. At the expiration of the first option, you have two possible outcomes. Either the stock is above 150 crowns in 1 month, or the stock is below 150 crowns in 1 month. Because you've sold this 150 call, you have that obligation to effectively sell the stock at 150 crowns in 1 month's time. So if the stock's above 150, you'll have to buy back that 1 month call, and you will have potential losses here to the downside. So if let's say during the 1 month time, the stock rallies, you will have to buy back that short call at a loss in order to hold on to your long call. Now, if the stock is below 150 crowns at 1 month, then what happens is you keep the 4 crowns, and now you effectively own that $150 call option for only 6 crowns effectively. And you can choose to sell another call option if you'd like to further reduce the cost of that long call, depending on whether you're neutral or bullish on the stock. So if you look at this, time spreads, when you look at this at first, can be a little confusing, right? Because you have two components. You have the long call, the 6-month long call, which is a bullish strategy. And then you're selling this short-term 1 month call option, which is a neutral strategy. So what we usually refer to a call calendar is that it's what we call it. It's a short-term neutral, long-term bullish view on a stock, meaning maybe you're bullish on a stock long term, but there's no earnings coming up in the next month. There's not a lot of things coming up. Maybe you think the markets are going to be fairly neutral. Maybe you think the markets may be a little bearish, and you're just simply trying to take a cheaper way to take a long-term bullish view. That's one of the times that you can trade a calendar. Basically, you're saying in the next month, I don't think the stock's going to move very much, but over the 6-month time frame or 9-month time frame, I think the stock will rally. That is a time where you could potentially use a calendar spread. That's one way. Another way is simply just, I'm neutral over the next month. I think the stock's going to stay where it is. So let me trade this calendar and try to take advantage of the fact that if over the next month the stock doesn't move, I can collect some premium and I can make a profit from that. Effectively, you're taking advantage of the fact that the short dated option will decay at a faster rate than the long dated option will decay. Because if the stock doesn't move, you have no real delta exposure. You really just have theta exposure, and the short dated option will accelerate in theta faster than what you lose on the long dated option. So I know this is a lot to take in at once, right? Because you're thinking about multiple time frames. It's a little bit more complicated than if you just bought a call option or just bought a put option. But this is a strategy that you can use in two possible scenarios. One, you just have a 1 month neutral outlook. You can trade the calendar and get out of the whole trade 1 month from today if you're right. So if you can trade the 6-month, 1 month calendar, and if let's say 1 month from today, the stock's still around 150 crowns, you basically take your profits and that's it. You close out your trades. Or you can let the first front month expire and sell another front month to keep collecting premium to offset the cost of that long call. So you only do that if you have that long-term bullish view of an underlying stock. So And I think another way to understand this, and I'll come back and try to answer some questions as well, is to also think about a slight variation of this, right? What if you are long-term bullish on a stock, but short-term you're not neutral? Short-term you're mildly bullish, right? So you think in the short run the stock will make a small move, but in the long run you think the stock's going to make a big move. Well, you can make a slight adjustment to this. You can buy the 6-month 150 crown call option for 10 crowns. And then instead of selling the 150 calls, you can sell a 1-month 160 calls. Now, when you do that, you're not going to collect as much premium, right? So here, I still pay 10 crowns for the 150 call, but here I'm only collecting 2 crowns for the 160 call because I'm selling a slightly higher call option. So what I do is I basically risk a little bit more money because instead of collecting 4 crowns for that 150 call, I'm collecting 2 crowns for the 160 call. My net debit is now 8 crowns. But as you can see, what it does is it allows me to make money if the stock starts to move a little higher in the short run. Now, this is just a slight variation of a time spread because it allows me to have a little bit of control over where I think the stock's going to go in the short run. So in both of these cases, long term, I'm bullish on the stock. So over the 6-month time horizon, over the 6-month time horizon, I think the stock's going to go higher. The question is, do I think the stock's going to stay where it is right now in the short run, or do I think the stock's going to drift a little higher in the short run? And that's where you can choose between trading a calendar spread if you think you're more neutral in the short run, or if you think you have a slightly bullish tilt in the short run, you can trade a calendar spread. Now, there is one thing that you have to pay attention to when you're trading a calendar spread. In the calendar spread, both strike prices have the exact same strike price. Okay. But in a calendar spread, you have different strike prices. So what you have to pay attention to is the debit that you're paying on a diagonal spread, if it's less than the width, you will not see any losses, even if the stock shoots up very quickly. However, if let's say I paid 12 crowns for a $10 wide diagonal spread, then what you're going to see is that this will actually start to see losses if the stock rallies significantly. So this is something to consider, that when you're trading diagonal spreads, you generally want to trade diagonal spreads where the debit that you pay is less than the width between the 2 strikes. Because if you pay less than the width between the 2 strikes, even if you're wrong on the short-term mildly bullish view, even if the stock all of a sudden just starts to take off, you're not going to see losses to the downside. You're not going to see any losses. With the calendar spread, if the stock takes off, you will start to see losses. So if you're wrong on that short-term neutral view, you'll lose money on this trade. On a diagonal spread, even if the stock takes off in the short run, you can still make a profit, but that only takes place if the premium that you pay for the diagonal spread is less than the width of the diagonal spread. So that just gives you a sense for how this works. And with the diagonal spread, you also have 2 possible outcomes. At expiration, the stock can either be above 160 crowns, or it can be below 160 crowns. So because I've sold the 160 call option, I really care about after the first expiration whether the stock is above or below that. If it's above that strike price, similar to a cover call, if you still have that long-term bullish view, just like if you are replacing that stock, if you have a cover call position, you want to buy back that call option and maybe sell another call option. But if the stock is below the strike price, you simply let it expire worthless, just like a cover call, and you can continue to sell more calls as well, or you can just hold on to the long call option, depending on going forward, if you are still more mildly bullish or neutral or very bullish, you can make adjustments as to what you want to do. So you could potentially sell a calendar spread this month because you think this month you're mildly bullish on the stock. And then once that call option expires, maybe go to sell a calendar spread now, because you think that over the next month, the stock's not going to move very much. And you can make variations of this depending on how much higher you think that stock can go. And if you think the stock's going to go much, much higher, then you could just let this expire and hold on to just the 6-month call option. So you really have a lot of choices here, but predominantly what you're trying to do is determine, okay, I have a long-term bullish view on a stock. Where do I think the stock's going to go in the short run? Because if I have a neutral view or a mildly bullish view, I can significantly reduce the risk of my long-term call option. And that goes back to our original discussion, right? Buying a call option is difficult to do because you have to overcome that break-even price. So calendars and diagonals are ways to allow you to overcome some of that cost, because here I've reduced my cost of that long call by 40%. I've reduced my risk by 40% by selling an at-the-money call option. And then with the diagonal spread, I've reduced my risk by 20%, but I give myself a little bit more upside. So it really just depends on what your views are in the short run and being able to take advantage of this theta decay, because you want to buy that long dated option and you want to help finance it. You want to help pay for it. You want to help reduce the risk of it by selling some short dated options. The question is just, which short dated options do you sell based on what your outlook is on the individual stock in the short run? Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. And I think the best at this point is the best thing to do is to take a pause and actually pull up this stock, because the calendar and diagonal spread, it's difficult to wrap your head around in the first time. So let's take a look at this example here. So here's a stock, right? That has had a pretty strong run here over the past few months. It took a pretty big move to the downside from about 143 crowns down to about 120 crowns, and then recently broke out above this downtrend, right? And has had a pretty significant move here to the upside. So maybe you think long-term, you really like the stock, but because it's had such a strong run here over the past few weeks, maybe you think the stock is more likely to trade sideways and consolidate a little bit before it continues to move higher. So that's just, for example, when you might want to apply one of these strategies. So what I can do is I can look at, okay, I think long-term I'm bullish on the stock, right? So maybe I'm going out to September, and I think by September, I think the stock will be significantly higher. So if I look at buying a September, let's say I buy a September 145 call option, that cost me 940 crowns. So my break-even price is $154.40. That's actually not much higher than the current price, but I still have to overcome that price by September. What if I think over the next few weeks, the stock is just going to trade sideways? If that's the case, then I can sell a call option against this to try to reduce the cost of my trade. So here's an example of what I can do. I can sell maybe a May 150 call option here, and notice how much I've reduced the cost of my call option by, if let's say over the next month, I think this stock is going to be more range bound, right? So if I sold the May 150 calls against it, first of all, I'm paying $8.9 crowns for the September 145 calls. And then if I sell the May 150 calls for 3.8 crowns, I'm reducing my net cost on this trade to just 500 crowns, of 5.1 crowns per share. Now, think about 5.1 crowns on my September call options. If my new cost basis on my September call options is only 510 crowns, that means my new break-even price on this long call is only 150.1 crowns. So my new break-even price gets reduced down to almost the current price of the stock. Meaning, if I'm right, and the stock stays roughly around here below 150, and the May 150 calls expires worthless, Now I own the September call options and my new break even is only 150 crowns. So even if the stock just moves up a couple of points by September, I'll be able to break even on this trade. So I've reduced my break even price by a significant amount by trading this particular diagonal. So that's one way to think about this strategy, right? Now, it only works if the stock stays where it is. Meaning, if let's say the stock rallies in the short run, so let's say this stock just continues, right? I trade this this diagonal spread, and the stock just continues to move higher. I'm wrong on my views. As you can see here, even if the stock moves substantially higher, I still have a gain, but the higher it goes, the more money I lose, right? So I actually start losing money if the stock gets up to 180 crowns. But as you can see, even if the stock gets to 160 crowns, I still make a profit. I just don't make as large of a profit than if I just bought the call option. So just to show you this, right? So if I just bought the September 145 calls, here I would have made 175% return if I just bought the call option. But if I traded the diagonal spread, I would lose. I would basically make no money on this particular trade because whatever I make on the long call, I'm going to lose on the short call. The two are going to offset each other when I trade this diagonal spread. But if let's say the stock stays where it is, right? Let's say the stock doesn't move very much, then I can make a profit in the short run, while if I bought the call option, I wouldn't be able to make a profit at all. So the goal here is to show you how you can make some small profits in the short run if the stock doesn't move, and then let me move this to the first expiration date. That will make more sense to you. So if let's say by between now and the May 21st expiration date, if I just bought the call option, I would lose money if the stock doesn't move. But when I trade the diagonal spread, I actually make a profit if the stock doesn't move. And then long term, I'll be able to reduce the cost of that long call and be able to reduce the break-even cost of my long call. So that's the trade-off that you're making when you're trading these types of time spreads. You're just basically buying yourself a little bit of time, taking advantage of that time decay. And the only downside that you have is that if the stock rallies, you don't actually make any money on this trade. You actually lose money versus buying that call option. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. And you can make modifications to this, right? Maybe if you think the stock's going to go a little higher, you don't have to sell the 150 calls. You can sell the 155s. You're going to collect a little less premium, right? And the benefit of that is that if the stock rallies significantly here, you don't lose as much money, right? So if you sell a higher strike call, you just don't lose as much money. And remember what I said. If you pay less than the difference between the two strikes, here I'm paying the distance between these two strikes is 10 crowns, but I'm only paying 6.85 crowns here. I'm paying less than the width. Then even if the stock rallies substantially, I will not have any losses. So as you can see here, that's why this graph tapers off here above the zero line. So I don't have losses. If you pay more than the debit, then it'll go below the zero line and you'll start to lose money as the stock goes lower and lower. So an example of that is if let's say I sold the calendar spread, right? And maybe the 150 is probably a better example of this. Let's say I bought the 150 and sold the 150, right? So the distance between these two strikes are zero. And I'm obviously paying more than zero. I'm paying 2.6 crowns here. So that's why if the stock rallies significantly, I start to see losses. But the calendar spread is really useful if, let's say, you just think that between now and today, now and the first expiration date, you think the stock's not going to move at all. Well, you can trade a calendar spread and profit from that, right? And the only other strategy that you can trade that's similar to this is shorting a straddle. But like I said, when you short a straddle, you have unlimited max risk here. As you can see, max risk, unlimited, right? And this happens if this stock continues to move higher here. If you short a straddle, you'll have unlimited losses. And notice how the break even between these two strikes are fairly similar. So at May 21st, your break-even price is 139, 162. So as long as the stock is between these two numbers, you're going to be profitable. As you can see on the straddle, very similar break-evens, but you are going to, the only difference is that you make substantially less capital on a calendar spread than you would on a straddle. Here I'm making 1100 crowns if the stock is at 150 versus if I'm here, as you can see, if the stock is just around this level 150, here I'm making 1,150 crowns. Here I'm only making 441 crowns. But the big difference is that here I can only risk 260 crowns. No matter what happens, I cannot lose more than 260 crowns. With a short straddle, I have unlimited losses. So that's what you're giving up, is you're giving up almost half the gains in exchange for not taking on unlimited losses and not requiring a huge amount of capital to sell a naked straddle. Because if you sell that straddle, you're going to have to post margin. You're going to have to post tens of thousands of crowns of margin in order to sell that straddle. Here, you only need 260 crowns. That's all you need to enter into a strategy that's very similar to selling the straddle. I tend to find that a lot of investors are afraid to sell straddles because they're concerned about that unlimited risk and they're concerned about the margin that's required to enter this trade. So a calendar spread is an alternative that you can use to that. So, that just hopefully gives you a better understanding of these strategies. And I hope that you'll be able to utilize OptionsPlay to play around and you really have to explore around a little bit to understand these strategies a little bit more. But hopefully this gives you that fundamental understanding that you need to understand the relationship between the long call and the short call. And then you can always apply that to the put side as well, right? So if you're looking at this and you're saying, okay, no, I have a mildly bearish view on this stock, then you can flip these to puts. Change the strike prices a little. Maybe you buy the September 150 puts and then you sell the 145 puts against it. Now you have a bearish view on the markets. So you can easily just flip this from calls to puts and take a bearish view. So you can do this for both strategies, for both calls and puts. And hopefully this gives you some understanding as to how to play around with OptionsPlay and construct these strategies. So when we talk about these types of spreads, there's a large variation as to how you can construct them. But generally speaking, the long leg should usually be at least 90 days or greater in terms of expiration dates, because those longer dated options greater than 90 days, they'll have very little time decay, which is what you're looking for when you're buying those options. And then when you're selling, you generally want to sell in the 30 to 60 day range. Roughly 45 days tends to be kind of a bit of a sweet spot here for these types of strategies, because that has the a higher time decay, but it doesn't have a lot of gamma risk, because when you get into the last 1 or 2 weeks before expiration, that's where you have a lot of gamma risk. So you want to avoid that as well. So the rough time frame is usually at least 3 months out to buy, and then 45 days roughly to sell. That's your target date. And you always want to roughly buy and sell the at the money call or put. So a 50 delta call or put is usually what you want to buy, and a 50 delta call or put is what you want to sell. Now, you can always have a slight tilt to it, right? So for example, if let's say I think the stock's going to move a little bit lower, then you can sell the 145 puts. If you think the stock's going to move a little higher, you can do the 150 puts, or rather calls in this particular case. But you can always just move it a little higher or a little lower depending on if you have a bullish or bearish tilt. You don't have to be at the exact current stock price. So for example, if I think the stock's going to drift a little higher, maybe I'll do a 160 calendar. You can do that as well. And that basically will pay you, will give you a nice payoff graph if the stock drifts a little higher here. So you have a lot of variation that you can do, but most commonly you would trade these where it's roughly at the money, because usually when you're neutral, you expect the stock to stay roughly where it is. And then on a diagonal spread, it's basically the same thing. What you're the strike price that you're selling, that short dated option that you're selling an out of the money call or a put. So usually a 20 to 30 delta is a good starting point, because that's going to collect a fair amount of premium, but also give you a little bit of room to the upside or to the downside, depending on if you're mildly bullish or mildly bearish on the trade. But this is generally speaking best when the short dated volatility is higher than the longer dated volatility. So if the implied volatility of the short dated option is high and the implied volatility of the longer dated option is low, that's the best scenario. That's the most optimal scenario for both of these strategies. So you can use them, a lot of investors will typically use them for earnings as well, because you have that vol collapse or vol crush on that short dated option right after earnings. So some investors that have a long-term bullish view on a stock but wants to take advantage of that volatility crush in the short run, they'll trade a calendar or a diagonal going into the earnings event. And then after the earnings event, they'll be left with that long call or that long put, depending on whether they're bullish or bearish. So that's kind of how these typically work. Now, as far as best practices go, the trickiest part with time spreads is that you have 2 time expirations. But what you really have to worry about is the expiration of the first leg, or the short leg rather. So the question that you have to ask yourself at the expiration of the short leg is, what is my view over the next 1 month? Am I neutral? Am I mildly bullish? Am I mildly bearish? And that will help determine what you want to do. Because if, as you approach expiration of the short leg, you generally want to close that out within 1 to 2 weeks of expiration. Like I said, if you hold on to that short leg in that last week, you have a lot of gamma risk, and you generally want to avoid that gamma risk. And one way to do so is just by rolling or closing out these trades 1 to 2 weeks from expiration. And what you want to do is you want to sell a new call or a put depending on your views. So if you're neutral, you sell a calendar spread. If you're mildly bullish, you sell a call diagonal spread. If you're mildly bearish, you sell a put diagonal spread. But depending on what your views are, so if let's say you're neutral this month and you sell a calendar spread, and next month you're mildly bullish, you might want to adjust that to a diagonal spread. So you want to adjust it based on your views over the next month. So you go out the same 30 to 60 days, and then you would sell different deltas depending on how bullish or how bearish or how neutral you are. The more neutral you are, the more at the monies you're going to sell. The more bullish you are, the further out of the strike prices you're going to go. But the goal is to continuously lower the cost of the long call or put that you own. So that 6 to 9 month call option that you own, you want to continuously reduce the cost of that call. The more calls that you're able to sell, calls or puts that you're able to sell against that long call, sometimes you can even reduce the cost of that long call to virtually zero. In this example I was showing you here before, if I bought the September call options for September 150 calls for 6.4 crowns or 640 crowns, but I collect 380 crowns for the May call options. The May options are only 51 days away. The Septembers are 170 days away. So I basically have 3 times of these May options that I can sell. And notice how I've already collected half of the premium. So even if I sold this twice successfully, I would effectively own the September calls for free. Because if I collected 380 crowns twice, that would pay for the 640 crown long call option. So that's really where you start to see this advantage, right? So that's how we're really taking advantage of this theta decay curve, because you can offset almost all of the time decay of one of these long dated options if you are tactical and you successfully sell a few of these shorter dated options. And that is how some longer term investors are able to effectively own a call option for free if they're tactical and they're smart and they're able to time the markets correctly with those short dated options, as I'm showing you here with SECU. So that's just a wrap up of what I wanted to share with you here today. Like I said, time spreads are a little bit more complicated. They involve 2 expiration dates, but if you break them down to their fundamental components, what you're really looking at is a long call and a short call. And if you understand both separately, you'll be able to understand the time spreads a little bit better. But at the core, what you're trying to do is just establish a long-term bullish or a long-term bearish position, and you're selling short-dated options against it to offset the cost of that call. Similar to what you do with a cover call, right? When you sell a cover call, you're collecting income against a long stock position. This is really similar to that. You're replacing that long stock position with a long call or a long put and you're just simply trying to reduce the cost of that long call or put by selling short dated options against it. And if you're able to do it effectively, you can really reduce the cost of those long calls, sometimes even down to zero or maybe even negative effectively cost to those long calls and puts. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a little bit insights into the creativity that you can achieve through options trading. A lot of investors see, different option strategies like long calls and long puts, and then you see variations of that like debit spreads and credit spreads. Well, calendars and diagonals are really similar to trading a debit spread. You're just trading a debit spread and actually maximizing the short dated option, the short option, because a debit spread, you're long one option and you're short an option. And the purpose of that short option is to offset the cost of that long option. Here, you're just taking that to the next extreme where you can sell multiple short options before the long option expires and further reduce the cost of that call option. Because when you trade a debit spread, you only have one expiration date. You can't reduce the call option down to zero. But with the calendar or diagonal spread, in theory, you could bring the cost of that long call down to zero or even negative numbers if you're tactical and you can collect enough premium. So with that, that covers what I wanted to share with you. And like I said, I hope that this was helpful for you. And a little bit of housekeeping here before we open this up for Q&A. We have a new Learn to Trade Options course. You can access this course. It has both beginner, intermediate, and option topics at going to trade.optionsplay.com/NordicEDU. I posted a link into the chat window if anyone wants to take a look. I highly recommend for those of you that are learning or want to freshen up on your understanding of options to take advantage of these courses. It's a 12-step course. There's 4 courses in each section in beginner, intermediate, and advanced. And it allows you to review everything that I've taught last year. And it shows you how to apply what you've learned to options play. And specifically within the beginners section, I had a buying versus selling options seminar. I think for those of you that felt today was a little bit more advanced for you, you felt perhaps a little confused by today's topics, I highly recommend you to go watch buying versus selling options and then coming back and watching this recording again, because it'll make a lot more sense to you if you have those fundamental building blocks of buying versus selling options first. So with that, what I'll do is I'll open this up for Q&A. There is a Q&A section at the bottom of your screen. There's a chat window and a Q&A window. If you could please bring up your Q&A window, you can type in any questions that you have regarding options trading, regarding calendars, diagonals, put them into the Q&A section, and I will answer your questions there. Corinne, yes, all of these courses are free. So all you have to do is go to this link. These are all free courses. Beginner, intermediate, and advanced courses are all for free. Any questions? No questions today? Normally we get a lot of questions. Daniel's saying, what about dividends? So whenever we're talking about options, options does not pay those dividends. However, they are factored into the cost of that call option. So the call option is effectively reduced by the cost of the dividend when you hold them through the dividend. So it is already factored into the cost of it, but you don't get paid the dividend itself. Mika is saying, how do you see credit put spreads with very low strike price? So, first of all, you have to then just sort by price. So we have this watch list function. So for example, you can actually sort all the stocks by price. So you can take all the Swedish stocks that have options on them, sort it by the price, and see, there are not a lot of them with very low prices, but you have Saab, you have Bets, you have Telia, Nordea, all of these have lower price stocks. So then if you want to sell a credit spread on Nordea, you click on it, you can click on modify, and you can select a short put vertical here. So if you want to sell a credit spread here on Nordea, you'd be able to see, selling the May 85, 82 and a half put spread will collect 90 crowns here in this particular case. So go to watch list, sort by price, and then just look at the stocks with a lower price rather than the ones with the very high prices. The trading site is very good and full info. Do you have any course on how to use the tool? So Auntie, a lot of the courses, all of the courses rather, use the tool. So it really depends on what you want to use the tool for. So I would suggest that you go to the course link that I sent you. Look at the strategies that you're interested in, right? Look, if you're interested in selling cover calls, if you're interested in credit spreads, go to those videos because I actually show you how to use the tools for each specific strategy, and use the tools differently depending on how you want it. So I would suggest that you go through the course, find the strategies that you like to trade, and I'll usually demonstrate how to take those strategies and apply them using OptionsPlay. Sigvard. So the strategy constructors are just meant to construct the strategies. They are not by any means optimized. So if that's what you're asking, they're just meant to help you construct the strategies. They're not selecting expiration dates or strike prices for you. What about only selling puts? So if you click on the income panel here at the top of your screen, right here, if you click on that income panel, it'll ask you, do you own shares of the stock? Yes or no. So if you're selling puts, you can select no, and we will show you the put to sell. And when you sell puts, you want to think about what is the annualized yield, right? So for example, if I sell the May 7th, 82 and a half put on Nordea, I'm collecting 100 crowns, which is 1.16% of the stock's value. So that's how you can utilize this tool to get a better sense for how much yield you're actually collecting on a put option. But click on the income tab and select no. That will show you the short put. Sorry, I meant Nordea selling a 50 crown put and buying a 40 crown put when the stock price is at 80 crowns. What is your question about that? So if your question is just how do you do that, you click on modify, use the strategy constructor, a short put vertical, and you want to sell there's no 50 crowns. The lowest strike price is 66. So if let's say you sold the 70 and bought the 66, first of all, I wouldn't suggest you to do that because you're not going to collect any premium. And just generally speaking, I don't suggest you to do that because, here you're effectively saying that I'll take 30 crowns, but I'm willing to risk 820 crowns for it. I don't suggest people doing that. But it's your account. You can do whatever you want with it, obviously, right? But this strategy where you sell very low strike prices on a stock. This is what we call picking up pennies in front of a freight train. This is going to work 9 out of 10 times. You'll collect 30 crowns each time, and you'll think that you're a genius. You just found a money-making machine, and then that 10th time, maybe it's a coronavirus, maybe it's a recession, maybe it's something else. Maybe 9 times you've collected 30 crowns. So you've collected a total of 270 crowns over the last 9 months. And then you have one bad month and you lose 820 crowns. And now, you're down 500 crowns because, 1 month wipes out the last 9 months worth of gains and more, right? So, you would have normally had to win about 20 months in a row just to offset 1 month of losses. So that's the reason why I don't recommend investors to do this type of strategy where it sounds great, right? You're going to win 90% of the time. People think that if I just win 90% of the time, I'll be profitable in the long run. It couldn't be further from the truth, because when you do that, more times than not, what you're risking is orders of magnitude more than what you are gaining, even though you win 90% of the time. So that's my suggestion to you. As you can see, the probability of profit here, it's very high. It's 88%, almost 90%. What that means is that 9 out of 10 times I should win, right? So if I win 30 crowns each time, I win 270 crowns over the next 9 months. And then that one bad month that comes along and I can risk up to $820, 820 crowns. If I have one bad month that wipes out 820 crowns, and the previous 9 months I've only made 270, that's not going to work out very well for you in the long run. So I hope that answered your question. Leaf is saying, is there a list where you can choose a strategy based on your trading view? So by default, so your trading view, you can put down here, right? I'm bullish and see 3 bullish strategies. I'm bearish, see 3 bearish strategies. So you can select your view and we show you multiple strategies for each view. And you can type in any stock that you want. So if you want to look at SEB, you're bullish on this particular bank. You click on this bank, you can select I'm bullish and see 3 bullish strategies, or you can select bearish and see 3 bearish strategies. Any other questions? You're very welcome. If there are no other questions, I just want to thank everyone for taking the time out here this evening. I hope, or actually one question here, Daniel saying, not a question, rather, I would just like to thank you for the time and good info you're getting. Thank you so much, Daniel. I really appreciate this. I'm really looking forward to continuing to do this here in 2021. And I really like what we're doing here this year, which is half the sessions will be on the markets, where we'll talk about just what's currently going on in the markets, what's moving, which sectors are strong, which sectors are weak, talk about ideas, talk about symbols. And then every other week we come back and we talk about specific strategies so that you can learn how to apply them to the broader market. So next time when we talk about some ideas, you might come back and say, oh, maybe I'll apply a calendar to that trade or diagonal to that trade. So constantly one-to-one strategy to market outlook. So I'm really looking forward to doing that here for 2021 for you guys. So thank you so much. Have a great evening. We'll send out the recording to you as soon as we're done, and I will speak to you here in about 2 weeks' time on our next Nordic Outlook session. Have a great night, and I'll see you guys in 2 weeks' time.